Okay, welcome to the deep dive. Today, we're really digging into some fascinating material.
We are. We've got the Financial Reporting December 2024 Examiner's Report here.
Right, and this gives us a direct line of sight into what examiners saw when marking the computer-based exams.
Exactly. It's not just pass-fail. It's about why certain things cause problems.
Mm-hmm.
Yeah. What trips candidates up consistently.
It shows real understanding. So our mission today is to pull out those key lessons, the common pitfalls, the examiner flags.
Give some constructive guidance, really. It's like getting the inside scoop on applying these financial reporting standards.
Think of it as finding out what really matters and what mistakes people tend to make.
Definitely valuable stuff, whether you're studying this stuff or just trying to make sense of company reports.
Okay, so let's dive in. Section A first, the objective test questions. These are more like standalone multiple choice ones.
Testing the core knowledge.
And the examiner flagged a few specific standards here. First one was government grants. That's IAS 20.
Ah, yes. The tricky bit here, apparently, was figuring out the net impact on profit or loss, specifically for grants related to assets.
You mean how the grant release lines up with the depreciation?
Precisely. The key detail, the thing people missed, is that the deferred income from the grant gets released over the asset's useful life.
So it should match the pattern of depreciation, usually.
Exactly. But candidates seem to struggle with calculating that synchronized release, getting the net effect wrong.
Right. Shows you need to know the mechanics, not just the existence of the grant. Okay, next was question 2. Disposal of a subsidiary. IFRS 10. Sounds complicated.
It can be. And the common error, calculating the profit or loss on disposal incorrectly.
What were they leaving out?
Often it was the non-controlling interest, the NCI. Or maybe the goodwill associated with the subsidiary, sometimes both.
Okay, so quick reminder for everyone, NCI is the part of the subsidiary the parent doesn't own, right?
Correct. So when you sell the subsidiary, you need to account for removing that NCI share too.
So the calculation involves more than just sale proceeds minus net assets.
Oh yeah. It's the consideration received plus the NCI at the disposal date minus the goodwill and minus the subsidiary's net assets, its share capital and retained earnings at that point.
Wow. Lots of moving parts. Easy to miss one.
Very easy. It really highlights the complexity of consolidation and, deconsolidation.
Okay. Question 3 was about intangible assets, IAS 38.
Yes, specifically amortization of capitalized development costs. The issue was people defaulting to straight-line amortization.
Or even no amortization at all.
Surprisingly, yes, even when the information in the question pointed towards a different method, like basing it on sales units.
So the principle is that the method should reflect how the economic benefits are actually consumed?
Exactly. That's the core of it in IAS 38. If the benefits are linked to sales, maybe unit-based amortization is better. It's not always straight line.
That's a really good point. An aha moment, as you say. You need to think about the economics.
Precisely. Just defaulting is a misunderstanding.
Okay, last one for Section A. Question 4, earnings per share, IAS 33.
Bonus issues were the problem here. 2 main things. People forgot to restate the prior year's comparative EPS.
Which you need to do for comparability, right?
Yes, or they messed up the calculation how to adjust the weighted average number of shares, the ones, for the bonus element.
Why is that adjustment so important? A bonus issue doesn't bring in cash, it just increases the share count.
Exactly, because it doesn't change the company's underlying resources or earnings potential, just splits the ownership differently. So, to keep EPS comparable across periods, you treat the bonus issue as if it happened right at the start of the earliest period shown.
Meaning you adjust the ones for both years being compared.
Correct. It's fundamental for showing a fair trend.
Okay, let's move to Section B. These were the objective test case questions, a scenario plus multiple choice. The examiner called out ISS 12 income taxes and IAS 16 property, plant, and equipment.
Right, let's tackle IS 12 first, deferred tax. It's all about temporary differences, isn't it?
The difference between the accounting carrying amount and the tax base.
Yeah, and these differences will reverse out later, but here's a specific rule the report mentioned, one that's easy to forget.
What's that?
Deferred tax liabilities are not supposed to be discounted.
Really? Even though it's a future payment?
Yep. Unlike some provisions, say under IAS 37, IAS 12 has a strict rule. No discounting for deferred tax liabilities. It's just a detail you have to know.
Huh. Okay, good to flag. What else on IAS 12?
The link to revaluations under IAS 16.
Yeah.
If you revalue land upwards, for instance.
It creates a temporary difference.
It does, because the carrying amount goes up, but the tax base usually stays at cost until sale. That difference creates or increases a deferred tax liability.
Makes sense. Tax isn't paid until sale, but the potential liability exists.
Exactly. And the report also mentioned issues with the journal entries. Like, if your deferred tax liability decreases, the entry should be a debit to the liability and a credit to income tax expense in the P&L. Getting the debits and credits right is crucial.
Okay. Now, IAS 16 itself, revaluations.
Right. So when you revalue land upwards, the basic entry is debit land asset, credit revaluation surplus.
Straight to equity, that surplus.
Correct.
Yeah.
Connecting back to IAS 12, you also need to account for the deferred tax on that gain.
Where does that go?
It's charged directly against the revaluation surplus in equity. So debit revaluation surplus, reducing the gain recorded in equity, and credit deferred tax liability. You sort of net the tax impact within equity.
Interesting. The report also mentioned something about the scope of revaluation, didn't it? A common misunderstanding.
Yes, this is really important for consistency. If you decide to revalue one item, say a specific office building, using the revaluation model.
You can't just do that one.
No.
Yeah.
You have to revalue the entire class of assets it belongs to. So if you revalue one building, you likely need to revalue all similar buildings, maybe grouped by type or location.
The class of assets, not just that single item and not necessarily all PPE. It's about grouping comparable assets.
Precisely. Keeps things fair and consistent. You can't just cherry pick assets to revalue.
Got it. And one last point on IAS 16. Transfers from revaluation surplus.
Right. Sometimes companies make an annual transfer from the revaluation surplus to retained earnings, maybe reflecting the excess depreciation on the revalued amount or when the asset is sold.
And the key thing.
Two things, really. First, it's often an accounting policy choice, not always required.
Yeah.
Second, it's a transfer within equity. It doesn't hit the profit or loss statement.
Just shuffling between reserves. Okay, that clears up Section B. Let's talk Section C. Constructed response questions, the longer ones where you show workings.
And that's the first major point the examiner hammered home here. Show your workings.
Absolutely critical, right?
Totally. A wrong final answer with no working gets 0. But if you show your steps, you can get marks for the method, even if an early mistake throws off the final number. Consequential marks are possible.
That's just good practice anyway. Shows your thinking. Let's look at the specifics. Clock & Co. involved group accounts analysis.
Goodwill calculation under IFRS 3 was part of it. Generally okay, but some specific errors kept popping up.
Like what?
Well, using the wrong number of shares if part of the payment was in shares. That's one. Another big one. Forgetting to discount deferred cash consideration.
The time value of money again. If you're paying later, it's worth less now.
Exactly. That present value calculation is needed. Also, errors in calculating the NCI's value at acquisition or mistakes in figuring out the subsidiary's net assets correctly.
Now what about timing?
Good point. If the acquisition happened mid-year, failing to time a portion of the subsidiary's results and net assets for that period was another common slip-up. Precision matters in these calculations.
Definitely sounds like it. Okay, what about the ratio calculation part for Clock & Co.?
The good news was most people used the format and showed workings. That's positive. But basic calculation errors were still common. Using profit before tax for things like ROCE or interest cover, when it should usually be after tax, or EBIT for interest cover.
Simple mistakes, but they changed the results significantly.
Hugely. Also, getting the definition of gearing wrong, which debt figure, which equity figure, or just basic arithmetic errors like swapping the numerator and denominator for ratios like net asset turnover, it suggests a lack of confidence in what the ratio is actually measuring.
Knowing the formula isn't enough, you need to know which numbers go into it. Now, the analysis and interpretation part for Clock & Co., the examiner wasn't impressed here.
No. Performance was described as poor. The main reason seemed to be, well, a lack of depth.
How so?
The analysis was often too generic. People would state a ratio went up or down, but didn't link it back to the specifics in the scenario.
So, no why. No connection to the story.
Pretty much. And crucially, given it was a group scenario with an acquisition, there wasn't enough discussion about the impact of that acquisition on the numbers.
That seems like a major omission.
It is. And discussions on the limitations of ratio analysis, especially for consolidated accounts, were also weak. Again, too generic. Not tailored to the potential issues in Clock & Co.'s case, like how consolidation itself can mask underlying performance or distort comparisons.
So the takeaway is calculation is one thing, but meaningful interpretation in context is the real skill.
Absolutely. That's where the higher level understanding shows.
Okay. And quickly, the report also mentioned Nucre Hall Co.
Yes, that one involved preparing individual company financial statements with adjustments based on IFRS. The report didn't list specific errors there, but it reinforces the need for solid knowledge across various standards for actual statement preparation.
Right. So we've covered a lot of ground, drawing directly from that examiner's report. Let's try and pull this together for you, the listener.
What's clear is that these aren't just exam hurdles. They're real-world areas where applying financial reporting standards gets tricky.
Understanding these common mistakes, the NCI and disposals, the WAN's restatement, the discounting rules, the scope of revaluation, the ratio components, it helps you spot potential issues when you look at any financial statements.
Yeah, it helps you ask better questions, perform sharper analysis. It moves you beyond just accepting the numbers to understanding how they were built.
And it really highlights that the details matter, doesn't it? A seemingly small error in calculation or misunderstanding a specific rule, like discounting deferred tax, can ripple through and change key metrics significantly.
Precision and understanding the why behind the rule, not just the rule itself. That seems key.
Which leads us to a final thought for you to mull over. If these technical details, how you amortize development costs, how you treat a bonus issue, how you account for a government grant, can fundamentally shift a company's reported profit, its assets, its key ratios.
Then what does that truly tell us about the importance of digging into the assumptions and the specific accounting policies behind every single number we encounter in a set of financial statements?
Maybe the number itself is only the beginning of the story.